The Federal Reserve is on the brink of finally cutting interest rates. If you haven't been paying attention to this, it's time to start, because changes in interest rates can affect everything from your mortgage to your savings accounts and even your investment portfolio. There are crucial steps you need to take to protect your financial future. I'm Brian Kelly, publisher of MoneyLetter, and I'm going to show you exactly how to prepare. Before we get into it, let's talk about why a rate cut would matter to you. When the Fed cuts interest rates, borrowing becomes cheaper. This could be great news if you're looking to finance a big purchase, like a home or a car, but it also means that returns on savings accounts and bonds could shrink. On the flip side, lower rates often push stock prices higher, as companies can borrow at lower costs, making their future earnings more attractive to investors. Okay, now that you know the significance of rate cuts, let's talk about how to prepare. Step 1, you need to review your debt. Before the Fed makes its move, you should look at any variable rate debt you have, such as credit cards or adjustable rate mortgages. If rates go down, your payments might decrease, but it could also present an opportunity to refinance into a fixed rate to lock in lower rates long term. You should start thinking about it now. Next, let's talk about investments. Rate cuts typically benefit both stock and bond total returns, but the edge goes to stocks. As interest rates drop, the yields on bonds become less attractive, and we often see more people shifting into the stock market. You might want to reassess your portfolio's balance between stocks and bonds, depending on your risk tolerance. If you're a conservative investor with a heavy bond allocation, it could be time to adjust. Before we get into more steps, I want to tell you about our investing community called MoneyLetter Friends. It's completely free to join. Included is a sample issue of our MoneyLetter publication and a weekly email that includes financial news stories, mutual fund and ETF recommendations, special offers, and more. Head over to moneyletter.com/friends or click on the link in the description of this video to join. Remember, it's completely free. Now let's get back to the video. Next, you need to plan for large purchases. A reduction in interest rates usually signifies a decrease in inflation. Before you do anything, make sure you do your research on the rates. The average rate for a 30-year fixed-rate mortgage is now just under 6.5%, according to Fred economic data. As for any big purchase, you need to be patient and really consider if it's the right financial decision for you. The one thing you can never predict is the market. Lastly, make sure your money is going into the correct savings account. The average return on a traditional savings account is 0.46%. In some cases, a high-yield savings account could net you a return over 5% now, which is above the inflation rate. You need to be aware that the average return on a high-yield savings account will almost certainly slide after the Fed starts cutting. There are a couple of ways to handle this. You could just leave it alone and earn a lesser amount of interest on your savings account funds. Or if you don't want to risk losing your current high interest rate, you could open a certificate of deposit or a CD. This account will allow you to lock in current interest rates. This strategy has a drawback, however. You cannot access your funds during the CD term. So, as the Fed gets ready to cut rates, now is the time to review your finances. If you want to stay updated, hit the like button on this video. Subscribe to our channel and leave a comment below. We'll see you in the next video.